Good evening, traders. Welcome to the Sunday Open. I am your host, Craig Shapiro, macro strategist here at NinjaTrader Live. Futures are now open, and we will get into things pretty quickly. I have an incredibly strong panel here with me this evening across multiple time zones. We got Pax checking in from the Midwest, Pharm from Arizona after his monumentous Halloween weekend festivities. And Sara's with me down here in Florida, so together we'll help prepare you for the week. Rocktober is in the books and November is now upon us. So I'll help frame the macro discussion and the catalysts that are coming up this week. And then the panel will be here to dial in on their trading ideas, execution levels, and how they're thinking about the new month and the ramp into the end of the year. So, but first things first, the open minis are up about 7, Nasdaq up 35. Crude has a little bit of a bid to it. There was some talk. OPEC had some news over the weekend. They are going to raise production in December, but for the first quarter of 2026, they're going to halt production. So that's giving crude a little bit of a bid here. Pretty quiet open, broadly speaking, which is nice because last week was catalyst filled. We had tons of earnings. We had the Fed meeting. We had the China trade talks. It was exhausting. We got a lot to get to this week with data. We got ISM tomorrow. We get the ADP job data on Wednesday. We have the Treasury's quarterly refunding announcement on Wednesday as well. And we have the Supreme Court hearing for the Trump tariffs on Wednesday. So a lot to get to, a lot to go through. But first, panel, how is everybody doing this fine Sunday evening?
Great. Hungry.
What's for dinner?
I'm taking my 16-year-old daughter out for dinner when we're done.
Oh, that's sweet.
Yeah, she blew me off yesterday to go to a high school football playoff game, so we're gonna have dinner tonight.
Aw. At least she still wants to hang out with you, yeah?
They all do. All my kids want to hang out with us. That's why we're so blessed, Sarah. All my kids
Of course. We all want to hang out with you too, so we get it.
What about you? Can you even taste dinner? You sound stuffy.
Me? No. So Florida blessed us with a change of weather. So I am sick. I'm currently, I'm not sick. I just have allergies. So I'm currently making tea. So if I cough, sorry.
Oh, that stinks. What's it like up by you, Pharm?
It's nice. The weather's finally cooling off just a little bit. It was only like 90 yesterday for Halloween. Was that yesterday? Oh, 2 days ago already. But in the evenings, it's getting into the 70s anyways. So today was nice, though. And we got, movie night tonight with the kids. So it's going to be a good day, I think.
It's going to be a cold and snowy winter in Chicago. I'm looking forward to it.
Yeah, I don't miss St. Louis winters. That's for sure.
I like it. I don't, you know what I don't like? And then we'll get into it. We got to talk about the markets. I don't like what we've had the last couple of years, which is 45 degrees and cloudy all winter long. I can't stand that. Give me the schnee and the cold weather. I'll take that any day of the week.
Well, Pharm, let's kick it off with you. How are you thinking about the setup here? We got a new month. What's the mindset like? Last month, Rocktober, markets finished, up on the month. Decent finish, gap up last week, a little bit of softness to the close on Friday, but they're getting right after it again here to kick off. How are you thinking about things this week? Yeah,
I mean, the big picture, we had broken out of almost a 6-week consolidation range in spectacular fashion, right? We had that gap up on Friday the 24th, and then obviously we opened last week on Sunday when we were here. Actually, Sarah and I were here. Big gap up that just was a gap up and go. And, it got a little bit extended, right? If you looked at ES and you just took that 5-week range, 6-week range, it basically hit a 1.618 extension of that range. NQ hit a 2.0 extension. If you just look over at the daily here. So, I mean, it ran pretty far, pretty hard. So a little bit of digestion after that is not unreasonable to expect some profit taking to come in. So it was seemed a little bit hungover for the back half of the week, but I think we can potentially forgive that. I will say at times it didn't really seem like routine profit taking to me at times. Some of the character of the selling was
the end of the month. It was just the end of the month trade, Pharm. That's all it was.
Certainly that last, 10, 15 minutes anyways, for sure. Well, that was some heat, right? But yeah, you got to kind of assume that, right? And then we'll see, how a new month opens, new month, new week, new day. And, we'll see how they bring, but it's all very, very constructive above that breakout. And we'll see if bulls come into play this week and, break this recent range to the upside. I do actually see a higher than normal probability that we take out both sides of last week's range though, this week, which would be amazing. So I'm hoping that we can get that done.
Yeah, I mean, last week was just, catalyst driven. So many catalysts, right? We had the Fed meeting on Wednesday. We had 5 of the Mag 7 reporting, and we had NVIDIA give their investor update. And then we had the Trump G meeting on Thursday with the trade deal. And so, I don't know, what I saw was, there was call buying all week. I mean, across indices, across all the big cap tech names. Vol kind of stayed, reasonably bid kind of throughout the week, even with the markets moving higher. And so, as we enter this week, or at least from Friday, saw some of the rolling of those positions, or some of the call premium, getting eliminated. And I think that was part of that month end last 30 minutes candle as well. But, as we enter this week, there is data, but it's like less intense, right? We don't have as much to really, focus on like we did last week. And so I think it's interesting you're talking about this two-way tape and maybe taking out the highs, but then also taking out last week's low. I think that kind of, range expansion makes a lot of sense. Makes a lot of sense to me too.
Yeah, we ended up with a bit of a broadening formation on ES. Just, we were making higher and higher highs all week, and then just kind of made lower and lower lows throughout to end of the week. And Q did not actually take out on Friday, did not take Thursday's lows. So it's a little bit different picture. But again, if you look at Friday's low on ES, it's basically just a partial back test of that. What day was that? Friday, I guess that was Friday the 24th high. Didn't quite even fill the gap. So if sellers were really that serious, they probably could have pushed another couple of handles. So, we'll see. And I'm curious to see which direction we go. Obviously, we're opening up here. So, but it's Sunday. It's a lot. I mean, when was the last time, and I know he's just not properly open here, but when was the last time they did not bid our markets? Was it like 1869? I don't know, something like that. So, I mean, I'm not really surprised it's up. We'll see where it's at in the morning. But yeah, I would love to see us, and honestly, given bullish context, I would prefer to trade lower first and take out last week's low, maybe properly fill this gap, have NQ come down maybe to like last Monday's low, and then reverse back in range. Because with broad bullish context, you'd want to go that direction. But hey, if we come up, we do not have a good high. So like if you got real bearish on the back half of the week because of, profit taking, or maybe it was more than profit taking. I mean, it's not like it's some fantastic high to write home about at all. So I would expect that to get cleaned up. And if it did pop those highs and leave a good cash hours high and then come back in range, it would need back below about 69.19 to 22 bare minimum to potentially cause any kind of bearish things to happen. But it's always fun when you take one side of the range and fail, for me anyway. So I'd love to see that. And now that I said it, it'll never happen. It's just the rules.
You can see this front month VIX getting dunked on here. November VIX now down back through 19 down to 1885. I think, for whatever reason, VIX was a little bit bid into the weekend, and, nothing happens. And so you get some of that VIX selling and some of that systematic buying just kind of comes back into the tape. We talk about this every morning, just about the systematic flows, and the other systematic flow that you get, is first of the month flow, right? You get those 401k pension contributions kind of directly into the equity markets will be coming tomorrow. So there's some front running of that. And so, the first of the month or the Monday gap ups have been pretty consistent now for quite some time.
Hard to be short in the beginning of the month sometimes, isn't it?
Yeah. Pax, what are you thinking here?
Oh, I keep saying over and over again, we haven't seen the high. I was a little bit surprised at how fast we came up last week. I think that we're, 69.80 is the price that I'm looking at and where I'll flatten up at in some swing positions. 69.80 is the target of the market on the upside in the S&P, and it's 27,500 now in the Nasdaq. But once we get up to 69.80 in the S&P, then we'll have a little bit of a reckoning. We'll have a moment of truth. If we can get 2 closes above that, then we'll trade up to 73 even. If we cannot get those 2 closes below it, I think we can see some volatility going into the year end. But right now, there's nothing interesting happening in the markets at all. We'll see what happens this week. There's a lot of, last week we had a lot of interesting catalysts, but this week we do too. We have ISM tomorrow, which can do something at least intraday. But we also have the Treasury issuance. We have the Supreme Court starts here. That I'll let you talk about. Supreme Court starts their arguments and tariffs. And, there's a lot of stuff going on this week that can really kind of have some important, what's the word? Some really long-term consequences for the market.
Yeah.
It'll be interesting to see what happens. In the meanwhile, there's nothing interesting. The swing in gold has been completed. It's setting up for another one. From the new quarterly pivot is 39.83. So, I want to be long at 39.83 and short below it. If we break 39.60 in gold, then I think we have another $200 below, down to 37.75. But, right now the gold swing completed at 44 even, and take a short down if you want to 39.60. And now that short swing is complete. I'm flat gold except for some longer term retirement stuff that I'll never get out of.
Yeah.
And the bonds are interesting. 30-year bond to me is very interesting. We've broken 2 full points from the high on Fed day of 119. I think it was 119.06 in the 30-year. We're down to a low last week of 117.04.5, and we're in the middle of the 117 handle. Do the bonds take out last week's low and trade down to the 15 handle? Very well could, and it's going to be quick. Otherwise, if it holds this area, then we'll just continue to churn and maybe drift higher with the indices. Who knows?
Yeah.
I have no strong opinion one way or the other.
Sarah, what about you? What are you thinking here?
Can we go to my charts? Thank you, Austin. So Pharm, you're speaking my language. You were talking about new opens for the day, the week, and the month, which is something that we very much pay attention to in the strat. And also we want a pullback also as well, because this grinding up at the highs is not, you can't keep, it's just very boring. Obviously you can't, to just keep buying up here is not very fun. It's not very volatile. It's kind of boring. So I'm going to start real quick with the monthly charts. We are nowhere near reversing last month's candle whatsoever. So nowhere near doing that. We're opening all the months with green. So full green time frame continuity on the month. And then on the week, I was really hoping, and this still could happen. We ended last week with ES and NQ sort of shooter weeks. Not NQ, not as much, but we would like something lower to look back to get long again. Oh man, my voice. Sorry. So if not, we're just going to keep kind of hanging out at the all-time highs, and there's just not a lot going on. Currently, ES looks to be trying to trigger Friday's high and targeting the all-time high. And currently, it looks like NQ is trying to go inside day and up and also target the all-time high. RTY is trying to take out Thursday's high. And same with YM, just trying to take out Friday's high and go to all-time highs. So that's kind of, I mean, there's moves to be made in there. It's just the ranges are getting kind of small. What else do we want to talk about?
It's a keep your powder dry sort of period, right? I mean, that's how I see it. If you're not long, it's going to be hard to be long, but you sure can't be short.
Correct. Yeah, exactly. Looks like oil is gapping up.
What's going on with oil, Craig?
Yeah, I mean, there was an OPEC meeting over the weekend where OPEC announced that they will be increasing production as expected for December, but because of seasonal weakness and some overcapacity that happens in the winter months, they are not going to be raising production again in the first quarter. So a little bit of a surprise there. I don't think that was expected. I think people were thinking that more oil was coming next month too, or certainly in the first quarter. And so oil has a little bit of a bid to it, up 60 cents here, 61.35 last. But oil's been lagging. Oil's been a struggle. Been hard to to find really a bunch of momentum there. I mean, it had broken down, kind of got back into range. I mean, what we know is the administration is desirous of having lower oil prices, right? I mean, Trump talks about wanting lower oil prices, but oil can't get too low because then you have some disgruntled supporters in oil producing regions in Texas and Oklahoma and the like. And so there's a bit of a floor to it as well. And so when things get a little bit too soft, you hear about strategic petroleum reserve purchases or a variety of other things. And so but when you bring in this idea about this CapEx build out and all the spending that's going on, the big constraint across the board is power, right? And so how do we get more power to drive compute, to drive AI spending? And oil is just part of the mix. It's part of the energy mix. It's languished for a while. I think this is a theme for next year for sure. And it seems maybe that OPEC's trying to get ahead of things here a little bit too by not bringing more barrels onto the market in the first part of the year next year. So we'll have to definitely keep an eye on oil here. I'm curious how you'll think about when we get some of this, fundamental data or fundamental stories, whether it's in oil or any particular, market, how you incorporate that fundamental flow or fundamental information with your more technical, price-driven, strategies here. So, Pharm, curious, maybe kick off with that. Just, to what extent is the fundamental data as it comes in an important driver of how you're thinking about setting things up for the week or for the month?
Yeah, I mean, to me, being a price monkey, I actually do like to see how price responds to data, right? So like let's say I'm looking at a volume profile and a weekly volume profile, and let's say it's a newer week and some crude inventories or whatever the hell come out, and it's seen as bearish crude, and crude sells off, and sellers can't find the sell button below yesterday's value or last week's value area low, for example, and it reverses back in range, then that suggests to me that sellers aren't very serious, and I'm likely to be pressing the buy button aggressively. So I'll look and see what that algorithmic response is, look and see where that fails, if it fails, and what kind of counter reaction we get to that. Because I'll read into that quite a bit in terms of what it tells me about the strength of the sellers or strength of buyers in a given situation based on what that initial reaction does. And I'll do that with all instruments. Look and see what the extent of that algorithmic reaction is, and what the profiles are telling me where price does not want to go often gives me an idea of where it will go after that.
Pax, what about you? How do you keep bias, fundamental bias about how you think things how you think things should go from how they do go? How do you keep that out of your trading? How do you put it into your trading?
I don't care much about the fundamentals or the technicals. I've got my process, and once the opening range has me positioned one way or the other, and I paid for the trade and I've taken profit, then I'm going to look at the longer term technicals, and I'm going to look at the fundamental story. Once I'm positioned is when I care more about the fundamental story. I'm not a fundamental trader, and I'm not going to make a macro trade in the indices or bonds or gold, or especially in the energies. I'm just going to trade my process, and when I have something on that looks like it can turn into a swing position or even a trend position that I can hold for a little bit of time, a few weeks, a few months, depending on the market, like gold is, then I care. And then at that point, I'll care about the macro.
Right.
I need to simplify everything, Craig. I'm not managing money for anybody except for my family, and so I'm looking for, like Sarah's going to say when we're done too, because we think very similarly. I need to know where I'm wrong before I take the trade, and I need to know where I'm going to take profit before I take the trade. After I'm able to pay for the trade, put my stops at break even. Now let's take a look at what's going on. What's the story? Why are we rallying? Why are we breaking? And at that point, I can make a decision as to whether or not I want to add to a position, using the macro story.
Right. Will you consider changing sizing and position, sizes into and out of, known catalyst events? So it's 8:30 payroll print or a 2 p.m. Fed meeting. You don't have a sense for where it's going to what's going to happen, but you do know it is happening. And so you're sizing down on that. You kind of look at price and then maybe, put your positions back on or size your positions back up, depending on
that
kind of thing about it.
Yeah. The idea, whether you're, no matter what number we're trading and what macro story we're trading, the idea is to probe the market with small size and to size up it as the trade is working and the as the clarity and the market direction is becoming clearer to me. Then the idea is to use a little bit of what I've locked in as trading capital and to exploit that. So I want to start small and then add significantly as we go. And then ultimately that's what sets us free. So many young traders are concerned about their stats. I couldn't care less about my stats. Most of my trades are probably scratches or small expenses. But when I catch them, I'm very quickly going to add to them.
Weak batting average, strong slugging percentage. That's how you roll.
Yes.
Sarah, what about you? How do you think about these fundamental catalysts and how do they factor into your, into your plan, into your trading?
I just stay out of the market while they're being announced and look to trade the reaction after. I'm typically looking for some sort of broadening formation within there or somebody just to have gotten stopped out so I can go the other way with it. We don't try to predict, which direction it's going to go. That's just, what for what. So better safe than sorry. And that's just how we do. And sometimes we'll trade after, sometimes we won't. If the range is really small, kind of not worth it. I think what was last week was FOMC. The range was pretty small till it wasn't. It expanded, but I was just like so bored with the market that day. I just decided to sit out. I was like, this is way too much brain power for no movement at all. So I just sat out.
Yeah, right. It was boring. It was and it was not an easy trade either. Like we've had every so often, like December 18th Fed day, almost a year ago. It was one of my best trading days of the year, and I wasn't expecting it. But during Powell's press conference, we broke like crazy, and it was we broke 245 points off that number. That was a great trade. And Wednesday, it looked like we had some downside, we had some downside potential, and then it stopped dead in its tracks. And I know it was. A lot of that came about because Powell, talked about having, I don't know, he was talking about. I'll let you talk about it, Craig. But whatever it was, the market, decided, well, maybe it's not so bad, and we began to drift up. It was not a good trade.
Yeah. No, what you had there was you had Powell deliver a reasonably hawkish message during the press conference, throwing some cold water on the idea that the rate cuts were going to happen again in December. There's a ton of pushback from a growing minority at the Fed who does not see the need to keep cutting rates here, worries about sticky inflation, worries about very loose financial conditions. And without the data on the labor market, because the government is shut down, they don't see this rapid pace of firing and deceleration in labor yet. So Powell wanted to push back against that. And we saw a very good move in fixed income, right? We saw bonds, we saw the front end sell off, in a pretty strong way here. And the odds of a December cut, went down towards 55, 60%. So we moved from kind of virtual certainty down to 55, 60%. So the bond market moved. Equities did react kind of at the onset of that. And then I think people became very focused on the earnings, right? After the close, we had Meta we had Microsoft, we had Google, and then the next day we had Apple and Amazon. And so very hard to, disconnect or disassociate the earnings story on these stocks from the Fed. And so I think what we had, I'm curious your thoughts here for all of you on Nasdaq, but Meta really looks pretty bad. Numbers not great, deteriorating free cash flow, needing to hit the bond market now in a very big way in order to fund the CapEx growth. You also had Microsoft similarly struggling with earnings. A couple of weeks ago, you had that big gap up in Oracle. That stock has also, really been struggling lately as they have a cash flow problem. Google, Amazon knocked the cover off the ball. Both were very strong. Apple did well, but kind of faded at the end there. So you have some divergence now in the Mag 7. NVIDIA obviously has been, up and to the right here for quite some time. But I don't know. How are y'all thinking about the Nasdaq here? And if we start to lose some of the stools, can the index kind of, keep moving higher?
Yes.
Yeah, I mean, NQ itself looks fine, but I agree that some of the generals have been taken out and shot a little bit, but we've still seen this rotation, and they're taking their turns, bidding them up and shooting them off, and that process can take time. So, but I agree that Meta looks like trash, and Microsoft's not that great either, for sure. Go ahead, back, sorry.
No, oh no. I think for me, as long as the Nasdaq is above 25,907, it targets 27,260. The Nasdaq has been stronger than the S&P has the last couple of weeks. So yeah, I think that I think the Nasdaq does have some more upside. It was also weaker a little bit and had some better rotations on Thursday last week. So I don't know. I really don't look at the internals very much. I pay attention, Craig. When you talk about them in the morning shows, it's when I pay attention to them. But I don't like having that thought in my mind when I'm trading. I just want to adhere to what my process gives me, and then I'll look for spots to add to my positions. I'm not going to have a 6-figure or a 7-figure trade or month or year or quarter by scalping my ass. I'm going to have those sorts of trades by adding to my size. That's ultimately what brings us freedom. So the whole idea here is that I'm going to stick to my process, and right now we're rallying. We're like Sara said earlier, we're creeping higher, and we've got some more room on the upside. It's awfully difficult to buy them in what we used to call the dreaded creeping rallies. This is a dreaded creeping rally, and it's hard to be along this. But I sure as shit, I'm not going to sell it either. I'm not going to sit here. I'm not going to get short this and and take a stand and say, that's it. You're not going any higher here. I'm not going to start picking tops any more than I pick bottoms. I'm not going to sell rallies, and I sure won't buy breaks.
Yeah. No, we're about half hour or so into this quiet Sunday open, which is a nice reprieve after last week. And thanks to the chat for joining us. And if you're not already a subscriber, please subscribe and like here the show. But minis are up about 14 handles, Nasdaq up 50, crude up 40 cents, gold a touch stronger here, back above 4,000. Dollar mix, bonds a little bit firmer. Heavy catalyst week coming ahead again. We talked about it's the first of the month, new money, new month. But tomorrow we do get some data. We get the ISM manufacturing survey, which will give us a sense for, to the extent this AI CapEx story is showing up in the numbers. And we know it's showing up in the stocks, in the sentiment and valuations. It's been slower to show up in the data yet. We've seen some of the regional PMIs have been a bit more sluggish, but we'll see this month if it shows up. I mean, the rest of the economy, the non-AI CapEx driven part of the economy, continues to struggle, and that's something that the Fed is cognizant of, right? We know the housing market has been softer. The low-end consumer continues to struggle. There were a ton of poor earnings announcements last week from the restaurant sector, from the low-end consumer sector, from some of the parts of the credit sector that are tied into low-end consumer. So there is a very large bifurcated economy and a large bifurcated stock market here, where the breadth has been deteriorating. It's fewer and fewer names that are all tied into the AI CapEx story that are taking us higher, and there is a growing concern from, various other parts of the economy and various other parts of the market that are struggling. And, I know there's been, some talks of this Hindenburg omen around. I'm sure you guys have seen this on Twitter, but it's a sign of, maximum dispersion, where there is a bunch of stocks that are making all-time highs or 52-week highs, and a bunch of stocks that are making 52-week lows. And it's typically been a potentially foreboding sign. Not always. We'll see. I think what'll determine which direction we go is liquidity. And are we getting more liquidity here into the end of the year, or are we not? And from the Fed, we just got a rate cut. We're going to get the elimination of QT starting in December. And we have very favorable positive seasonal flows. I mean, Santa Claus is coming to town early, according to many. And so, that's favorable. But we've also started to see a growing concern in the repo markets. In some of the, plumbing here into month end, there was a large hit on the Fed standing repo facility, $50 billion for month end. And so there's been some strain from smaller banks and some highly leveraged financial institutions and non-bank financials. And so we'll have to see if that continues into November. Pax, we talked earlier, the Treasury is giving an update on Wednesday morning on its duration issuance calendar. And to the extent that will they be issuing more bonds or more bills, that'll be a subject for debate. It'll be interesting. That's 8:30 on Wednesday morning. Could be a big catalyst for fixed income. But how are you guys thinking about these catalysts for this week? In the mindset here, and are these things that you think can change the direction of the tape in one way or the other, or again, it's really
Yeah. Let me ask you about, Craig, with the repo facility last week showing strains in some of the regional banks. How much of that will play into the Treasury issuance this week?
So
and the shutdown. How does it all play together?
Yeah, there's definitely some consistencies or some reasons why this is happening together. I mean, part of the reason that we've seen a bit of a funding strain is that the Treasury has been, not paying out its expenses, right? The government is shut down. And so, probably $6 to $8 billion a week that it would normally pay out is not being paid out. And so that money is not hitting certain banks and is staying in the Treasury's general account. And based on the way that Treasury has funded itself and has done a lot of this bills issuance, it has raised its checking account, which is known as the Treasury's general account, has gone up from $850 billion at the end of September to basically $1 trillion now. So it's pulled over $150 billion out of bank reserves, over the course of the last few weeks here. And part of that's because they're not paying out, some money to these banks. And so there really is no sign that the government is going to reopen this week. I'm not even sure the House is in session. I mean, I think there's some talk that maybe some of these SNAP benefits will get paid, but it's not clear. There really doesn't seem like to be a imminent solution here. So that's going to continue to keep some pressure on funding markets for sure. Part of it was a month-end dynamic. So the reverse repo facility picks up capital at the end of the month. And so that was part of it too. So I think that goes back into bank reserves this week. But if we continue to see banks pulling on this standing repo facility this week, more and more market participants are going to get concerned. And so we'll have to just monitor it. We get those numbers, twice a day. There's a morning facility and an afternoon facility, and we'll see. As far as the Treasury's decision at 8:30, there's really no expectation for a change in duration issuance composition. Treasury continues to issue way more bills than bonds. Eventually, it will have to step up its duration issuance and issue more notes and more bonds. But Beston's pretty smart. He understands the dynamics here. He doesn't want to put a lot of pressure on the long end of the curve. And so I think he's probably going to table this issue for another 3 months and kind of deal with it next year when they know that rates are going to be lower, because this Fed will be cutting rates. And if not, the next Fed will be cutting rates even more aggressively. And that's what the government is. That's what this administration is trying to find the next Fed chair who's going to deliver on more rate cuts. So, but the repo things are kind of, out there in the ether. They could get worse. It may be nothing, but traders need to kind of keep an eye on some of the funding markets here, watch the front end of the curve. We'll talk about it on the show tomorrow and throughout the week, but this is something that could kind of sneak up on people as liquidity is drained, as banks are strained, leverage comes down, collateral values are coming down because there is more concern about parts of the economy and the values of lending to the low-end consumer, and like delinquencies are up, credit card delinquencies are up, auto lending is slowing. And so there is some strain in this bifurcated economy. So a lot to think about, a lot to digest, across it. I think, we can use the front end of the fixed income markets as a guide here. And if we start to see a little bit more volatility in treasury markets, that could be something that starts to get equity guys to notice. I think if you look at the dollar, right now dollar's, been flat to this evening, but dollar's been starting to pick up a little bit momentum to the upside here. I don't think strong dollar is something that folks are particularly positioned for. The administration has been desirous of a weaker dollar, and now we're starting to see a bit of a stronger dollar here. So, when you get an environment of dollar up, yields up, and oil up, those are some headwinds that could start to, creep into the equity market. But again, have to balance that with the flows, have to balance that with volatility likely coming down. Some of the, the positive gamma dynamics we talk about, and some of these buybacks. The other thing that we're going to start getting now is share buybacks, right? I mean, the share buybacks, we're through earnings season. Now the buybacks start again and the Mag 7 are, really at the forefront of that. So, all things look, good into year end here from a seasonal point of view, but we do have a lot of this headwind we kind of have to chop through.
So that headwind now, let's say to your question earlier, we drift up to 69.80. Maybe we close above that. And there's some upside momentum up to 73 even. When we make it up there by Christmas, if we get up to one of those macro zones in my work, I will short those. Those are tops that I will pick. I will sell that with a tight stop, because there is a day of reckoning coming, and we'll know it. It's going to be obvious. It's when it happens. It's going to be fast. It's going to be furious, and we'll all know it. And buying breaks is going to be the fool's errand that'll run everybody over. We saw part of that earlier this year when we broke from 61.66 all the way down to 48.34. That was an obvious sell, and then we stopped there and we got back above 49.5. That was an obvious buyback. So we have got a lot of headwind coming up. And when I get positioned, then I'm going to look at those headwinds and see how they're all matching up together. And those, when the market has you positioned correctly and the technicals are backing it up and the macro story is providing fuel to it, those are trades that make your month, make your quarter, make your year. So yeah, I'll be looking for those. And going into not so much the end of 25, because I think we'll just kind of drift higher, but going into the beginning of next year, it's going to be a fun year.
Yeah. Now, I put a note out a couple of weeks ago, just looking at some of the blow off patterns that I thought we were seeing across a variety of subsectors. We were seeing it across precious metals. We talked about that. We can talk about gold too, again, but we saw it in quantum computing and some of the crypto names and rare earths and things like that. And so I'll be watching those sectors to see if they can make new highs here in the coming days and weeks. And if not, that has me a little bit concerned. And then look, some of these big cap tech names are already starting to stall out, right? I think Oracle and Meta are very important because they are the two most levered names to this AI CapEx story. They have the worst free cash flow growth profiles right now. They're both hitting the bond market. They're both hitting the credit window here. And, I think Oracle topped out 6 weeks ago. Meta clearly had some big trouble last week on earnings. And, when you start to shoot the generals, it just becomes that much more difficult for, the indexes to keep moving higher. Clearly, so far, there's been rotation, that folks felt comfortable rotating into Amazon and Google and the like. And, they'll rotate into some of the energy names and some of the AI CapEx build out power stories, can continue to get bid. But these big cap names are an exorbitant part of the indexes in size and composition and ownership. And so if we start to lose some of that, some of that strength, it's going to be much more difficult for this tape to keep moving higher into 2026. Pharm, what are you thinking here on that front?
Yeah, two thoughts that I have. I mean, first for this week, We've got ADP, which is, the best we're going to get for jobs for right now. And I've held for quite some time that all the market really cares about is the strength of the economy. And I think that really comes down to jobs and passive flows into 401ks and whatnot. And we've had, I don't know what, 3 out of 4 last ADPs have been negative, I think. So, it's a given that's the best catalyst we can do. It's going to be interesting to see if that's positive here. But I don't think the market has cared for a very long time about inflation or how many rate cuts. I mean, what was it, 2024 we went into like pricing 7 cuts, I think, and we got like 0 or whatever it was, like 1 or 2. I don't know. It didn't matter, right? We just went higher. It's short of like, an immediate algorithmic response, just like FOMC pricing out, pricing down the probabilities of Friday. We got some selling, right? But where'd we go afterwards, right? Right back up. So I think that the market broadly cares about potential for a weakening economy. And like you've said, it's bifurcated, right? So as long as the middle class, the wealthy are still spending, the numbers are going to look okay and the market will be fine. So I'm definitely looking for the jobs data and to see how the market reacts to that. But my second thought is into December 1st. I mean, I think the Fed just gave bears a gift by ending QT, and doesn't necessarily mean you're going to get a short, but I think they gave bears a gift. You remember last year coming into December, everybody and their mom was calling for a huge melt up in December. It's not exactly what happened, is it? The market had no excuse not to go higher last December, and the market really has no excuse not to go higher in this December. So to me, if the market is sluggish in December, again, like it was last year, I think it's a sign potentially that some caution is warranted into the beginning of the year. And it's also a gift to bears, because if we just go piss missile in December, then you just go back to sleep for a month, come back after the first of the year. So like, it's a gift either way, right? Like it either gets you excited to get ready and sell the thing, or it lets you know to just stay hands off. So I'm very much looking forward to see how that responds, because like if you can't bid this thing after the official end to QT and all these rate cuts and everything the Fed has done from their perspective, and the Treasury has been very supportive of growth, like if they still can't bid it, then to me it suggests maybe it's a little bit tired.
Yeah. Sarah, how are you thinking about it into the end of the year here?
We are not going down anytime soon that I can tell. So,
yep.
And don't get me wrong, I would love a crash. It's just like a crash, like we had at the beginning of the year, like we dumped for a few months and then we got nice monthly hammers, and what was it, May or June or something? And it's just been straight up every month since then. So until that changes, we're not getting any kind of significant correction. I don't know what it'll take, but actually it could take a new year. When we get a new yearly candle, then the continuity could possibly change. Then we might get a sell-off, but that's not till January. So
where do you think negative divergences will show up first? If you look across, let's say the 4 indices you have up here, I mean, where would you expect to see the weakness evince itself first? Would it be in small caps, or do you think it would be in these big tech names? If you had to surmise based on the strength of these charts, how would you think about it?
I don't care which one goes first. I'm just watching all of them. So like I was saying earlier, I want to break a previous week's low. And ideally, they all 4 do it at the same time, which gives us strong evidence to short, because the whole market's doing the same thing at the same time. We call that a simultaneous break. So I'm just watching and waiting, and I've got my alert set, and I'll be ready whenever they decide to pull back a decent amount. But until then, we just got to play a day at a time, really see what we get each and every day.
Yeah. No, I mean, for me, the things that I'm watching for are these just negative divergences that have started to show up a little bit in the credit markets.
Yeah.
Credit spreads not confirming this most recent move to all-time highs. We're seeing some credit spread widening in certain parts of credit markets, whether they be exposed to low-end consumer, whether it be into the student loan sector, whether it be into autos, or now increasingly into the data centers and some of the AI CapEx stories. And so keeping an eye on that, for possible signs that the economy is showing more signs of strain. And then I agree with you, Pharm. I think this market has shown, some receptivity towards that labor market weakness, right? I think when we get if we get more confirmation that the labor market is really decelerating and that these Fed rate cuts are not really going to do much to arrest those declines, then I think you'll have some of that negative feedback loop develop with respect to the passive flows, right? You don't get as much of the 401k contributions. You get more folks who are concerned about their job security and maybe will reduce those contributions into the 401ks, or we know that 401k hardship withdrawals have been rising materially over the course of the last several quarters as more people need that money in order to pay bills. And so I think that those two dynamics, and we do get a big data point this week from ADP. Like you said, it's been a month. We've had 3 of the last 4 months have been negative. ADP has announced that they are going to start to give us now weekly data. So they're going to give us now they're going to give us now the 4-week trailing average weekly job creation, which is going to be a very important data point now going forward. I think that's going to come, I believe this week we're going to get Wednesday, and then going forward, I think every Tuesday morning, we're going to get a weekly update. So we're going to get more data from ADP at least, which will give a firmer sign now about the strength or weakness of the labor market. And we know from these companies, right, we had a big Amazon announcement a couple weeks, that was last week, 30,000 or so layoffs, Target, variety of other big names. And the more that stocks react positively to layoff decisions, which is what we've been seeing, the more companies are going to feel comfortable about making layoff decisions, or at least layoff announcements into the end of the year. And so I think that train is going to continue. And then structurally from AI going forward, I mean, the AI story is a labor displacement story, right? The more we have AI and the more we get productivity gains, the worse it is for the labor market. So I think this day of reckoning is coming, where more and more people are struggling to find employment, or getting more concerned about the future of their employment. And if we start to lose that support for equity buying, and we start to see more of this credit market deterioration, and then it kind of festers into the data center part of this with the Oracles and the Metas and others that are trying to procure capital to build out these data centers, then I think you get kind of the 1 + 1 + 1 = 100 story, and that becomes a larger sell-off probably for next year. But again, the seasonals, the flows now really makes it seem much more difficult to see that happen in 2025.
Yeah, from my perspective, in terms of which one would sell off first, I would normally say the Russell, because it belongs at 0 and possibly negative numbers. Russell Perma-Bear here, but
I'm sorry, I should have muted out. That was hilarious, and I'm with you. I'm so with you.
It's such a basket of shit, but so family show. Look, no, seriously 100%. Though, on a serious note, I would encourage every single person in the chat and every single person watching, go back and look at November of 2021 and November of 2024. And if you want to see what a top looks like, look at the 100%. Russell. Most obvious thing you have ever seen in your life, and you will never miss it again.
Right.
Now, do they do it again, or because Craig, you've talked a little bit about this. They've gone from shitcos to ultra cash furnace shitcos now, which is very bullish, right?
Right.
So maybe it doesn't top first because it's got a lot of the quantum stuff, and if they catch another run, maybe it doesn't top first. Maybe it's the Dow, because the concern again. The only reason this market's going to sell is if the economy is going to weaken. So maybe the Dow makes sense. I don't know. We'll see. But normally it's the Russell, and it's usually a month or two out. So,
yeah, I mean, this is not, like you said, this is not your father's Russell 2000 anymore. This is not your kind of stodgy, small cap, old economy stocks, right? This has become a place where you get quantum computing exposure, where you get AI CapEx, nuclear exposure, where you get rare earths, where you get crypto miners, because these have been the unprofitable parts of the economy where stocks have gone to the moon this year. And so these companies are not in the Nasdaq, they're not in the S&P, they are in the Russell 2000. And so you've had, massive gains across a lot of these names that are tied into the AI CapEx build out, and has created, people think of the Russell as kind of this broadening out rally, but really it hasn't been. It's just been a lot of these hyper-focused names in the AI story that have gone to the moon. And that's why I thought it was so important to see some of these, what I thought were going to be or look like blow off tops earlier this month. And so I think the reaction to the next few weeks of trading here, can the quantum names make new highs? Can these nuclear names make new highs? Can these crypto miners make new highs here in the coming days? Are they going to start to roll over as liquidity is drained here and as the repo markets stay struggling, and as banks are hitting the standing repo facility and the Fed has stopped QT and they're a little getting more concerned about the funding markets? Then I think the Russell will do exactly what it always does, which is top early. But clearly the weakness now in the economy is really away from that. The weakness is in transportation, it's in low-end retail, it's in restaurants, it's in travel, it's in things where the consumer who is stretched is having a tougher time. And so you're seeing it in a lot of the subsectors, right? You're seeing in some of the sector ETFs. And some of, like I said, mentioned, restaurants have been destroyed and transports have been, pretty weak, and regional banks have not done incredibly well. And tertiary financials, the Sallie Mae's and the SoFi's and some of these business development corps that are tied in there just have been, very weak. So you're seeing under the hood, this negative breath, I think is getting worse. But the way the indexes are composed, it's, you're just not, you're not really seeing it. And I think that's what's created this bizarre dynamic here where the economy feels not great outside of AI, but equities continue to, slough it off and don't really care, because the equity market is tied into increasing this AI story and the AI capex, and that's the mega theme. And so as long as that keeps doing incredibly well, it's going to be hard for the indexes to break. But when we start to, hit some of the generals, like maybe we're starting to see now, then watch out, because I don't see the rotation. I don't see the rotation out of AI capex into anything else, right? The economy's not going to massively recover with a 25, 50, or 75 basis point Fed rate cutting cycle from here. It's going to take a lot more cutting from the Fed in order to really stimulate parts of the economy that are away from the AI capex story. And so that, that has me concerned here. But let's just take another look here at the tape. Minis are up 20, Nasdaq up 85, Crude up 67 basis points. Gold is basically gold's now back down under 4,000. Dollar is picking up a little bit of momentum here. Kind of a quiet, bonds are quiet. So I think what we're seeing is this, vol selling to start the week, to start the month, expectation of flows coming in to the tape for the first of the month. But as mentioned, we get some data. We get some data early tomorrow. Curious, there happens to be an election this week. Not many people talking about it. True. Big election in New York. Do you think that there is any market implications from a Mamdani win, a Democratic pickup here in some governor seats? There was a poll out today that showed that the Democrats' chances of winning back the House in 2026 now are basically back to the highs of the last 52 weeks. So some concerns about Trump's polling data. Can that be market moving? Can that be something that becomes an issue for the tape, or certainly for the administration, as we push through here into the end of the year? I'll take that as no one thinks that this is important.
No, I do. Well, I think it's important for a lot of reasons, because these elections are going to have ramifications for like we were talking about before we came on, for the Trump agenda. If the Democrats come out next week pretty strong, I think that's going to that's going to show some cracks in midterms possibly. I don't know. So yeah, that'll have ramifications. Look, like Pharm said, I was looking at this earlier. If you look at the pattern, last week, the pattern last week, it's a couple of weeks early, but it looks exactly like the week of November 6th of 2024. It's the same basic gap, same basic run up. and then we drift near the highs. So this is a keep your powder dry market, and don't pick tops. Like we've all kind of agreed that there's still some upside room here, but keep your powder dry and don't get your ass in trouble until these huge trades happen, because they're going to happen, whether it's new momentum to the upside driven by AI, and whatever else comes out. Maybe there's peace in the world and we just start running. Nobody cares about that. Here we go. We trade up to 8,000 in the S&P, or, there's significant headwinds, and there's a lot of cracks in the foundation, that can bring the everything debt bubble to something to, pay attention to. Who knows? But, whether you're trading on a 5-minute, time frame, looking at breakouts like Sara was showing us on her charts earlier, or you're using the opening range, or you're using more fundamental and technical aspects of it, we all agree that there's still some more upside in this market. And then, my long-term goal in the S&P is 69.80. I haven't made that a secret. I think we achieved that, and then we churn it just like we did last December. 61.50, 61.17 to 61.25. We made a high of 61.53, broke, made a high of 61.63, broke, then the all-time high, and then we broke like mad. I don't know that we break like mad, but we're eventually going to find that high-end price, and we're going to sit and churn it until I think the beginning of the year. And that's when it's going to be fun. So the point is keep your powder dry until those big trades happen. Don't guess when they're going to happen. Trade when they're going to happen. React to them.
Max, what was your upside level for NQ? You said 69.80 for ES.
It's 25,907, which we're above. So that now targets 27,250.
27,250.
Yeah. So 27,250 should, that's 1,200 points away, but that should correspond with someplace in between, like 70, 50, maybe 7,100 in the S&P.
That's a pretty psychological level. It's exactly halfway between 25 and 30.
Is it?
Well, basically, yeah.
Yeah, I'm with Pax. I've been on the phone daily with my Barrelholics Anonymous sponsor, trying to refrain from selling this pig. Sometimes he doesn't pick up, and I just have to. I slap the sell button a few times. Sometimes it works, sometimes it doesn't. I'm texting him right now.
I didn't hang out with you enough. I didn't hang out with you enough in Florida. You're hilarious.
Yeah. I'm kind of a perma bear, but I like selling them. Who doesn't like it?
I do too.
When it breaks, it breaks, and it's glorious, and you just kind of hold on and just let it go. But I was texting him just a minute ago and saying if this fails up here at 95.5 and reverses back through, I'm gonna have to sell it. And he said, all right, me too. It's not very helpful, buddy. His name's Craig Shapiro, guys. He's not very helpful as a sponsor, but no, I agree. It's it's not time to get mean and get short, but once in a while, a little sell never hurt anybody. For sure.
It's hysterical. What did you say about the Russell? The Russell was that was a great line. I wish I remembered it.
I got so many. It's a basket of shit wrapped in a basket of shit. I got a whole bunch of them on the Russell. Yeah, I get on with that. It's like a basket of shit that a radioactive rat drudged through. A rat that had crawled up a skunk's ass and died. And, whatever. It's just. There's a nude picture of Rosie O'Donnell plastered to it. It's just nasty, just nasty stuff. Where do we start with it? Russell to the moon.
Oh my Lord, that's awesome. Holy shit! I'm sorry. That was really funny.
That seems like the type of thing you end the show on something like that. But we're coming up into the hour here. Just a last look at the market. Minis up 19, Nasdaq up 82, bonds a touch stronger, oil up 70 bips, gold a little bit sanguine here, down 20 basis points, Bitcoin up 70 basis points. That's a market that I continue to really focus on. Luke Roman calls it the last functioning fire alarm. It's a good test of liquidity. It's been struggling to break. It's up, now, but it's been struggling. The chart doesn't look great here. October was canceled for Bitcoin. We'll see if Movember happens, but I don't know if Bitcoin and crypto can't really get out of its own way here when the seasonals are good and liquidity is good. Maybe that's signaling a larger issue here for the tape. So I don't know. What do you guys have any thoughts on Bitcoin as we?
I still
bring the
want to
show
see
to
a
wraps?
new all-time high.
Yeah. No.
Sarah, let's have November take the lows of October and then piss missile up into January. How about that? You're okay with that?
Yeah,
Can we
but we
take
did just take these lows, which I like. So this is like a
Yeah.
re-entry right here. So
Yeah.
you could take this one too, because if the bears if the bears aren't weak enough to take out the lows, then they're trying to buy them up. So they're trying to like buy down here.
That low pissed me off absolutely for that exact reason. I wanted to take out October lows in November, but yeah, Craig,
so it's making a little broadening formation in there. High, low, new low. So it's coming back up through, and then here's your mama broadening formation, right? So we want to come back up here.
It's definitely closer to that. That wick down is on the 10th, I imagine, that weekend, right? That was the Trump tariff stuff and the liquidation we saw. And it's definitely the asset class that's closer to closer to the lows of that sell-off than anything else. And so it definitely has me a little bit concerned. But I don't know. Just
it has
I'm surprised it has.
week.
Yeah, exactly. That's a great way.
We just took out anybody who'd been long since July when we did that mid-October. So like that's good enough for me. We stopped them all out.
I don't want to be short. I don't want to be short until we're below the 200-day moving average at 104, and I don't want to add the longs until we take out 113,800. If we take out 113,800, then we'll piss missile. Then we'll piss missile to all-time highs. 113,800. That's a great line. I never heard that before.
Piss missile. That's
Yeah.
I don't know if I like it.
Trademarked.
Sorry, Sarah. That's crude. We should not be talking like that.
No,
Sarah.
I love crude. It's just that just wasn't funny to me.
They can picture Rosie O'Donnell. That's going to be in my head now.
That one was funny. That was for sure.
Well,
We'll
this
get 'em next time,
I think
Pax.
that's.
We'll get 'em next time.
I think ending the show on Piss Missile is probably a reasonable place to be. But want to thank everybody again in chat for joining us here on the Sunday Open. Thanks to Pharm and to Pax and to Sara for being with us. I will see you all in the morning live again at 8:00 tomorrow as we kick off the week with Deli and Chai and the team. And so thanks again. This was the Sunday Open.
See you in the morning.
Great job, everybody. Great show. A lot of fun. Next time we get together, I'm sitting next to you, Craig or Cal.
You got it.
All
right. See you tomorrow.
Thank you. Take care.
Have a great